Hello and welcome back. I'm Natalie MacDonald. You're watching Dukascopy TV and this is Sydney Direct. Now I'm back in the beautiful Shaw Stockbroking offices. Today I'm chatting to Julius Garofali. Julius Garofali, thank you so much for welcoming us back into the office today. Lovely to see you.
You're very welcome, Natalie. Thank you for having me.
No problem at all. Okay, so firstly, walk us through Q3 performance as seen by Shaw Stockbroking.
Okay, so the September quarter, the third quarter, actually fell 2% for the ASX 200. Few extra weeks, 3 weeks leading into October, saw another 5%, so 7% pullback. Look, you're going to get decent pullbacks around the September quarter anyway. Historically, the market does pull back almost every year I've seen since being in the share market. You find that also stretch valuations, fund managers and money managers like myself struggle to find value in the market, so you're going to kind of see us reluctant to invest when the market gets a bit toppy on a price earnings valuation. Also, our iron ore price actually had fallen $97 per tonne down to $80. One of our largest exports, along with other commodities falling as well. IMF cutting their growth outlook. Obviously, it's going to dampen sentiment for the world. A lot of noise on the monetary easing out of the States. It's going to see a lot of those US funds or US money leave our market and head back home. I think also the RBA Assistant Governor here in Australia, Guy Debelle, actually in the press talking about how investors were unprepared for a potential violent shock. I'd actually have to play that down, because I think that for a violent move in our market, we'll need to see a significant shift in investor sentiment, and I'm just not seeing that at the moment. I'd like to talk about the August reporting season here in Australia. Earnings per share growth was around 7.1%. The actual revenue growth itself was only up 4.8%, and this was across our top performing or our top companies. Now, a lot of that wasn't actually from revenue growth, it was from mostly cost cutting. So what I'm actually seeing is that in order for companies to grow next year, how they're going to grow, they're not capturing revenue growth, they can't cut costs forever. They're going to have to actually take out their next door neighbours, so to speak. And I'm finding with interest rates at 60-year lows and corporate balance sheets very fat, I think that's where the next level of growth is going to come from, M&A.
So that's Q3 taken care of. Now Q4 has been described as a significant buying opportunity. Is this something that you would agree with?
Of course, Natalie. Valuations are looking very compelling, and certainly dividend yields. I wouldn't be surprised to see a lot of retail money now starting to come back into the market. I'm seeing some of our top well-known names yielding at above 6%. I found that the volatility index last night actually fell the most that I've seen all year, and that actually can be seen as a buy signal for the market, not just for us but even globally. I actually started accumulating more blue chip stocks for my clients as of Monday. I think that the market having fallen 7 to 8% in Aussie dollars actually has opened up a lot of value. But if you look at our market priced in US dollars, we're actually down about 11-12%. So we're actually very attractive in global dollars. So it's going to be quite enticing for the offshore investor once again. I wouldn't be surprised to see the next 3 months the market have a little bit of uplift just based on that. I personally ignore the noise surrounding Europe. I believe that Europe is actually slowly recovering. It looks like the US did 2 years ago. Investors, I think, should remain patient there. Europe actually acts just like one big bureaucracy. I think things are going to take a little bit longer there, but I personally think that things are on track. I don't pay too much attention to the IMF downgrade. I think their track record is poor, and I think that their data is more backward-looking anyway.
Now, volatility dominates the ASX at present. How are you advising your clients to take advantage of that almost?
Well, Natalie, volatility can be taken advantage of in a number of ways. Personally, what I do for my clients who typically hold the top 20 blue chip stocks, I sell exchange-traded options against those shares. What that actually means is you can sell a call option on, for example, Commonwealth Bank at a higher price than what you paid for it. And when volatility goes up, the premium you receive for the option is actually a lot bigger than when volatility is lower. So, for example, the VIX as I last saw it a few nights ago, was at 30 as opposed to 12 about 4 weeks ago. That translates into a lot more option premium, and that can actually help really benefit the retail client in terms of getting probably an additional 2 to 2.5% return on their portfolio per year. So that on top of a yield of say 6% or 5% in Commonwealth Bank's case, you're going to get about 7.5% per annum. I think a more vanilla strategy would be via Macquarie Bank. I think that with their fixed income commodities and currency trading business, with increased volatility, you're seeing that those businesses actually generating more turnover, and that therefore translates into higher earnings for Macquarie Bank. Just on Macquarie Bank, I'd like to add other reasons why I do like it. I think that corporate balance sheets in development countries are actually a lot higher than they've ever been. I think that the global cost of capital is low. Growth is low globally anyway, and I think that also share prices globally, although we're not at all-time highs, but we are near all-time highs, and that means that corporate shares, so their shares are like currency, so they see that as currency for takeovers, and that provides very attractive for them in a non-dilutionary basis. So I think that all this actually fuels upside for M&A, and Macquarie Bank being probably the biggest investment bank in Australia and one in the world, you'd want to capture that upside in investment banking revenue via Macquarie Bank. I also think that the weak Australian dollar actually very much benefits the bank. You find that now 75% of Macquarie Bank's earnings are coming from offshore. I think pre-GFC it was about 30%. So look, in regards to Macquarie Bank, I think that with increased deal flow from mergers and acquisitions globally, translates into performance fees, a falling Aussie dollar, it should provide a good backdrop to Macquarie Bank's result on the 31st of October. We're expecting $1.16 per share to be announced for the dividend.
Julius, thank you so much for your comments and insight today. Much appreciated. Thank you.
You're very welcome, Natalie.
That was Julius Garofali there of Shaw Stockbroking. Don't go away. I've still got plenty more exclusive interviews coming up for you right here from Sydney, Australia. For now, though, it's goodbye from me.